While markets celebrated record highs this week, the most profitable traders I know were asking a different question. Not why are we rallying, but what does this behavior reveal about human psychology? The answer is exploitable because most participants are operating on muscle memory from 3 years of double-digit gains, yet their actions show cognitive dissonance. Here's what happened. The Santa Claus rally failed for the third consecutive year, eroding seasonal confidence that typically anchors January positioning. When familiar patterns break, humans abandon systematic thinking and revert to emotional reflexes. The jobs report became the perfect Rorschach test. 50,000 payrolls missed estimates, but unemployment fell. This ambiguity allowed both bulls and bears to claim validation, creating the psychological sweet spot markets needed to grind higher without triggering profit-taking. Defense stocks revealed the clearest example of exploitable behavior. Wednesday, Trump threatened to block buybacks and dividends. Panic selling ensued. Thursday, he promised a massive budget increase. Euphoric buying followed. Lockheed and Northrop swung 8% intraday on policy commentary, not earnings or fundamentals. This whipsaw exposed participants operating on headline velocity rather than probabilistic outcomes. Those who survived both moves likely reduced exposure, creating liquidity vacuums that will amplify future volatility. The rotation from growth to value, from mega-cap tech to small-cap industrials, is being celebrated as market health. The Stoic approach reveals something different. The Russell 2000 surge reflects FOMO among those who missed last year's rally, not strategic reallocation. After years of concentration in the Magnificent Seven, participants are experiencing diversification as novelty rather than risk management. This is behavioral contagion masquerading as broadening participation. The system absorbed these inputs and produced record highs despite underlying fragmentation. Monday's energy rally gave way to Wednesday's tech weakness, then Thursday's defense surge before Friday's semiconductor close. This sectoral rotation within a rising market signals distribution disguised as breadth. The system isn't broadening. It's cycling through sectors in sequence while others consolidate or decline. Volume patterns confirmed this interpretation. Monday's elevated activity coincided with Venezuela catalysts rather than organic accumulation. The VIX, rising to nearly 15 on a day when markets rallied over 1%, revealed embedded tension. Participants bought protection even as they added exposure, classic late-cycle behavior where conviction remains fragile despite rising prices. The bond market provided the week's most important signal. The 10-year yield held above 4% despite jobs data that should have driven yields lower. This stickiness reflects competing forces, fewer expected Fed cuts, and concerns about fiscal expansion. The yield curve's refusal to steepen aggressively suggests the market is pricing a scenario where growth remains modest but inflation stays elevated, the worst combination for duration assets. Commodity markets told a story of supply disruption rather than demand strength. Oil's 4% Thursday rebound after Venezuela-driven selling demonstrated how quickly geopolitical narratives override fundamentals. Gold approaching 4,500 and silver surging above 80 reflected uncertainty hedging, not inflation fears. Participants are buying optionality in an environment where policy clarity remains elusive. The technical picture shows indices grinding higher on declining momentum. RSI readings in the mid-60s, MACD flattening, and internal divergence between index performance and constituent behavior. All classic late-cycle patterns where fewer names carry the load while the majority consolidate. History shows humans consistently mistake price movement for validation. The disciplined observer recognizes that record highs occurred on contradictory signals. Weak jobs paired with falling unemployment, tech weakness masked by semiconductor strength, energy volatility disguised as sector rotation. The system isn't resolving uncertainty, it's deferring it. The jobs report's ambiguity is exploitable precisely because it allows positioning to persist without forcing conviction. The defense sector's whipsaw exposed the cost of narrative dependency. Those who traded both moves paid the volatility tax twice. The small cap rally is built on assumptions about rate cuts that remain unproven. Second-level thinking means recognizing that markets can remain structurally fragile while appearing superficially strong. The crowd reacts emotionally to each headline. We remain disciplined in our process. Position sizing reflects uncertainty, hedges reflect tail risk, and conviction stays calibrated to information quality. The market's ability to grind higher on ambiguous data isn't reason for optimism, it's reason for discipline. The system is rewarding participation over insight, and that's precisely when the stoic exploiter becomes most cautious. If you value systematic thinking over emotional noise, Subscribe for frameworks that exploit human predictability. Download the complete Stoic exploiter methodology in the description, because while others chase headlines, we study the psychology behind them.